Hello, thank you so much for joining me on Morning Markets. It is another sea of red in the equity markets as well as the bond market. Higher for longer. The markets are just now getting their heads around it, and that means we are being meaningfully repriced lower. Traditional safe haven areas like utilities, like real estate, they're struggling to be those safe havens under the weight of those rising rates. Today on the show, we're going to be unpacking where does it end? At what point do you need to get concerned about your portfolio? And at what point do you start pulling the trigger on some buys? For that, we've got a great panel of experts. Michael Purves is the CEO of Tallbacken Capital Advisors. Brad Lamensdorf, co-portfolio manager at the Ranger Equity Bear ETF. And on set is Chris Kerlow, portfolio manager at Canaccord Genuity's team LWC. Gentlemen, thank you so much for being with us. I mentioned that the bond market is sort of the tail that's wagging the dog here, if that's the equity market. The question is this just a much needed repricing evaluation, or is this a sign that we're close to a breaking point? Michael, how do you think about that? Whether this is the market bending or the market breaking?
Look, I think it's bending, but I think it's bending a lot, and I think it's going to bend for quite a while here. I think what's happening in the bond market is really, it's really pronounced on the back end of the curve, which is where you find the discount rates by which you're going to discount the cash flows on your various risk assets like stocks here. And there's a lot of key structural shifts that are happening here. This is not about rate hikes. This is about term premia. This is about longer term structural forces pushing what I think is inflation to a higher floor here, not just here, but probably overseas as well. And so I think, it's a much slower moving Treasury sell-off. It doesn't feel like it, but it really is when you compare it to last year's Treasury sell-off. It's a very different Treasury type of Treasury sell-off. And but that's just because it's slower doesn't mean it's any less significant. They're in fact probably more so, because I think what's happening is we're getting out of this post-rate shock, post-rate hiking shock world of last year into these slower moving forces that are probably more sustainable in a way there. So I think that's, look at Treasury yields, but look at UK yields, look at German yields, look at Japanese yields. You're seeing, this re-steepening of the curve happening across. And I think that's a very substantial dynamic in the markets that will be felt for a while in equities.
And Brad, I'd love for you to pick up on that point, because your target suggests that the S&P 500 could drop another 25% from here, which sounds like a big number until you realize, well, it did that about a year ago, and then it did that about 2 years prior to that. So in this rising rate environment, do we just have to get used to these kind of large, sharp corrections? Brad, that's for you. Can you hear me?
I'm sorry, I couldn't hear the other guests. Yeah, we actually think that when you're analyzing forward dividend plus your forward earnings yield on the S&P 500 relative to where the interest rate environment is, you're looking at least 3,000 to 3,200 without a recession. So we're pretty bearish in here. We think equities are extremely mispriced relative to the fixed income world.
Chris, how are you thinking about this? Sometimes pullbacks can be presented as an opportunity. Are we there yet, though?
We think this rise in bond yields has really been on the back of kind of imprudent spending by the Fed. We've seen the budget deficit expand by $1.3 trillion in the last 12 months. Last time that happened was 1994, and the 10-year reached 8%. So, I mean, there's probably still room for this to run. And they need to pay the piper. We saw the government shutdown averted this week with the Fed, willing to pay there. But to keep up this spending, there's going to be some retribution, and it's going to have to be more Treasury issuances. And who's going to buy them? There's no more quantitative easing. Foreign buyers are looking elsewhere outside the United States, and the banks aren't in a position to buy it. But unlike, I think, the 3,300 prediction, we think the value in the Canadian dividend space, if you're looking out longer term, there's tremendous opportunity. We also think, hedge against this inflation. We're super long on the energy transition phase, but we're doing that actually with traditional hydrocarbons. Oil at $90, and these drillers not doing the typical drill baby drill. There's an opportunity here for great free cash flow from the traditional energy market.
So dividends, what does that mean? Are you going into utilities? Are you going into banks? Are you going into real estate? Because that's a really tough environment if yields go to 8%.
It is, but in our Canadian dividend portfolio, we're longer term investors. The energy trade I talked about is more of a trade. We're articulating that through an actively managed mutual fund. But we think with our client base that needs that dividend income for retirement, with the valuations you see in telcos, utilities, interest rate sensitive securities, it's not an ideal position, but we think over a 3 to 5 year horizon, they'll be significantly higher than where they are today.
When you talk about this repricing, Michael, where do you think it ends? Is 8% realistic?
I think 8% is a stretch here, but if you look at the 10-year, it has blown through big round numbers. 4% was supposed to be a level where it gets bought, then 4.25, then 4.5, and I had a near-term tactical target of 4.75, but I could easily see it getting 5 to 5.25 here. I think one of the interesting things here that we saw from the Federal Reserve during the September FOMC is they're kind of playing footsie with this issue about where their long run, the R-star, where the long run interest rates, neutral rates are really headed here. And if you look at where their if you just average the real Fed funds rate in their forecasts over the next 3 years, or their nominal Fed funds forecast over the next 3 years, per their projections, they are so much higher than their long run 2.5% nominal, 50 basis point real Fed funds. So I think ultimately we're heading to a place where we're going to get guidance that, hey, that 2.5 long run number may be a little bit higher here. And I think that can get you, this repricing across the curve, and I should say curves because it's really global, could get you to, 5.5, maybe 6% here. I think at that point, you got to stand back and think about, well, wait a second, that is pretty substantial. Right now, real interest rates on the 10-year are very, very high. And they do represent value here, but we're going through a lot of technical breaks here. And I think my colleagues' point about government deficits is a very good one, that, we do have a new structural aspect of contractual payments, hundreds of billions of dollars of incremental cash flow going out of the federal government every year, adding to the debt to GDP. And that is sort of a compounding factor that's going to ultimately mean that fiscal response down the road when you have a crisis is not going to be as easy to come by as it has been over the last few years.
And yet Chris was willing to kind of be opportunistic in some of those sectors that could be vulnerable to a rising rate environment. Are you as willing? I keep going back to utilities just because it's multi-year lows. The ratio of underperformance relative to the S&P 500 is at records. At what point do we say enough is enough?
Yeah, look, I think, look, I share, I have a structural long view on energy equities. I think that's a great place to be here over, 2-year time horizon. ExxonMobil just made a fresh high here. Utilities have been just getting destroyed over the last few days. And at some point, those are going to be a great long there. I think there's what's happening also, just look at futures positioning across the Treasury curve. It is at record levels here. There's big hedge funds, both long, short, and macro, that are pushing this rates trade pretty aggressively. And they're pushing, I think, things on the short side like utilities. That's what it really feels like when you look at the price action here. Those pushes don't go on forever here. So I think those, like utilities, I think they'll probably set up for a nice bounce here. Banks have been getting really beaten up, and for all sorts of very understandable reasons here. But at some point, the big banks will be good buying opportunities here too. There, so I think there will be good opportunities here. Where I'm most cautious, frankly, is in the big tech space, where I really do think ultimately, once the AI sort of hype mellows out, you're going to start seeing valuations show much more sensitivity to these higher interest rates.
Brad, I'd love to unpack some of the strategies that you're using on the short side. As I understand, it's both on the equity market as well as in treasuries. How are you putting that into practice in the portfolio? And at what point do you think, all right, enough is enough? We've seen the selling pressure and it's time for me to ease off a bit?
Right, and we use typical put-call ratio, sentiment gauges, none of which are showing any type of real fearful action that we tend to look at. We've raised a little cash. Fortunately, rates are moving up, and when we do short, we do get to take advantage of higher rates in the fund for our cash. So that's been helping us actually quite a bit relative to the last 10 years where short funds, were really robbed. But we're very focused on the consumer. We think that that's where we want to short. We've been short auto finance. We've been short some of the regional banks. We were short the REITs. We've reshorted them recently on the bounce from the summer. So we think all the same problems are still very, very, in front and center and going to get worse.
All right, Brad, we have to leave it there. Thank you so much to Brad Lamensdorf, as well as Michael Purves joining us from Tallbacken Capital Advisors, and Chris Kerlow on the desk. Actually, Chris, I'm going to hang on to you for specifically about the Canadian markets, because some really core holdings for Canadians are getting beaten up. The bank stocks, the pipeline stocks, what make up the bulk of our TSX 60 are now trading at 52-week lows or more. The telcos, all, very household names in a Canadian portfolio. You're looking at the returns. What do you do?
Yeah, so we're looking actually at, like I mentioned a few minutes ago, kind of a longer-term valuation perspective. But to your point, the interest rate sensitivity in these names is challenged. We're looking at adding at this point, but honestly, we're a little hesitant coming into Q4 with tax loss selling season upon us because of these names trading at 52-week lows. We could see a bit further of a washout there. We've been
like a worse one than we typically see.
Well, I mean, to your point, 52-week lows. If you want to regain those, you're not going to sell your Nvidia today. You're going to go sell your Telus. But we think in Q4, if that selling pressure persists, we could be doing things like adding a structured note where we're basically taking a bet that 3 to 5 years in the future, that basket of telcos or utilities or bank stocks is going to be higher than it is today. Banks is one area we still remain a little bit cautious at. The valuations are getting attractive, but we think Q4, there's still going to be some more washout on the expense side with restructuring and otherwise. So,
do we have to get used to large pullbacks in a rising rate environment? I mean, it might just mean we don't go straight up like we're basically used to since the financial crisis, but maybe, every year, every other year, we pull back 20%, 30%.
Yeah, markets are faster now. Access to data is available ubiquitously from me or somebody at home using Questrade. The opportunity to move in and out is crucial, and we employ a tactical asset overlay on our portfolios. I talked about the energy trade. We're actually reducing cash right now, buying into some other positions. But that cash position, we were getting paid 5% to wait on, and so we are starting to deploy some capital in the areas that look attractive, but again, hesitant on some of those longer duration, particularly tech assets like our former guest mentioned.
All right.